This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Welcome to the Rational Reminder Week 12 with Cameron and Ben. So we were not sure we were going to be able to record the podcast today. We thought maybe we'd have to do it at my house because I had power. The office didn't have power until sometime this morning.
Late last night, yep.
Yeah, I checked in the afternoon. It was very stressful for me because, as everyone that listens knows, I had just bought a huge pile of grass-fed beef, 180 pounds, loaded up in my freezer. So with no power, I was getting pretty nervous. I felt like I was kind of playing chicken with the power outage. I was waiting. It's kind of, I think you have 24 hours before food starts to go bad in the freezer. So I was waiting. At about 20 hours in, I went and bought a generator, plugged my freezers in. So I was good.
And you got the last one, right?
I got the very last one. I had to hedge my bets.
So I'm going to use this as a bridge to our guest this week. So we have a great special guest. Doug McKenzie is joining us. Doug's been a friend of mine and a client for 7+ years or so.
Just about that.
And I remember you had the ice storm in Toronto, how many years ago?
Yeah, that's got to be 10 or so now. Yeah.
And your story is exactly what Ben lived yesterday or Saturday, running around town trying to get a generator. So you were able to get one, right?
I got the second last generator
Wow.
at that point in time. Yeah.
You were a long time without power.
We were actually one of the last 2,500 houses in Toronto to get power back, and it was
Wow.
actually a team from Manitoba that physically hooked us back up.
Wow.
Yeah. So there you guys have a tie that binds you two together. So a couple of weeks ago, we had Carson join us in our weekly discussion and shared his thoughts on long-term planning. With Doug in town today from Toronto, I thought it'd be a great opportunity for you to share your story, because I find your story fascinating, how you decided 7 years ago to really hone in and to focus on your ability to retire and to be able to be financially independent. And I mean, you came at it from two ways. And I was hoping you just tell us the story, because I think you came at it from making sure you had enough saved up, but also you went at the expense side of the equation so well.
That's right, exactly. But 7 years ago, we were coming into the retirement horizon, with 10 years to go if you're considering the traditional 65 stop point. And we knew we were doing well, but we didn't know how well we were doing. And we were also, working fairly hard at tracking our expenses, but not getting the perfect results that we wanted. So just wanted to have a second opinion, if you will, on the whole thing. So that's where our focus started, and we were doing what a lot of people do. We had spreadsheets going and doing some couch potato stuff and different things. We got into focus at that point in time, and we really got serious about it.
And you actually cut expenses, right?
We did cut expenses. We discovered, little things, whether it was as small as, buying coffee every day to trimming down and researching our insurance costs across the board. And we were able to lower those. Actually, just did that again 6 months ago. Reinstituted that project and made some more savings there. The way we shopped, all sorts of different things. There was no one great single expense reduction, but everything cumulatively really helped out.
So one of the things that you mentioned is doing some couch potato stuff, which I find really interesting because you're someone who works on Bay Street for a big financial institution.
It probably seems counterintuitive, you're right. But my side is on the corporate and commercial side. My personal financial expertise was okay at best. But as we came into the focus zone, knowing that there was about 10 years to go and kids were just finishing university and, different horizons were changing, that's when we really wanted to get a focus and make sure we were doing it the right way.
Right.
Do you think your investment approach changed as you approached the retirement date?
I would say yes. We were always fairly conservative to start with. We always look for value as opposed to the quick hit. So just, preservation of capital was certainly in at least the back of mind, not necessarily the forefront, but just being careful and smart about the whole thing.
So you own Toronto real estate?
I do.
What are your feelings, or how do you think about that market right now?
For us, where we live, it's been a bit of a lottery that none of us could ever have known. But the way it factored into our plan, my wife doesn't want to leave the house or until the absolute last possible moment. So the house was left on the outside of the planning. We wanted to get there with our own monies. And what happens now, the house, it's been paid off for quite a while, so that's helpful. But it's kind of the insurance program now. At the end, if we reach a point, down the road in retirement that we need to sell it, we can do that.
It must be amazing to think there's that many people coming up behind you that can afford these houses.
Yeah, we marvel at that. We look at our neighborhood and wonder how these kids are doing it. They're kind of in their early to mid 30s. They have massive mortgages is the only thing I can assume, or strong parental support as well.
So as people's portfolios grow, we notice that people become gun shy making trades. Kind of the fear factor kicks in. So have you seen your portfolio progress along? Can you talk about the kinds of worries that you have when you think about your portfolio? Or do you worry?
A little bit from the standpoint of preservation of capital again, and given that we are getting closer and closer to the retirement side. We were never aggressive investors to start with, and certainly one of the things about working with you guys and going through Dimensional is just we see value in it. I've always kind of been a value investor. That really fits for us.
So this must be so contrary to, I'm only assuming, right, but between you and your colleagues on Bay Street, like this is not how a typical person on Bay Street thinks about investments. Is that safe to say?
That would be true. I talk to various people, and we're very much different than a lot of them are. A lot of them are banking on big bonuses coming down for the next few years. A lot of them are banking on cashing the house out when the time comes. But to me, there doesn't seem to be a lot of long-range planning to the whole thing.
What do you think was different for you? How do you think you ended up thinking about it differently from your colleagues?
We just wanted to make sure that we could preserve, our quality of life all the way through. That was really the key driver to it. Okay, interesting.
But the fact it was within reach is what must be really motivating for you.
Right.
At that time, even say we kind of pin this down. I mean, we reviewed your plan here this morning, and it's solid. So to know that you were that close to having everything buttoned down must have been, pretty good feeling.
It was, yeah, and it was. I mean, PWL put the confidence, or the final level of confidence, back into it.
Cool.
So one of the things that we've been seeing a lot about online recently is that this month marks the 10-year anniversary of the start of the financial crisis. So Lehman Brothers collapsed under $600 billion of debt. You were not at Lehman, but you were right in there. What was that like?
It was scary times. Being in the industry I'm in, funding went away almost overnight. And a lot of people were wondering, where's it all going to go? Can business continue? No one knew what the depth of it would be at the end of the day. Some emergency funding was done in my industry to put the stuff together that was backed by the government. In the end, it wasn't really tapped into all that much. But I can remember being at a conference this time 10 years ago when the markets just crashed on the one day, and just the long faces around this conference were just mind-boggling.
Wow.
And funding dried up.
Funding totally dried up. We were fine where I was, but for a lot of secondary players or level 2 players, funding was virtually gone overnight.
So having been through that and knowing what you know now, do you worry that something like that could happen again?
I guess it could always happen again. I just feel that personally I'm insulated from it now. If it does go, a lot of people look at the administration south of the border and worry that something, close to cataclysmic could happen again. No one knows for sure, but we're long in the cycle right now. You get lots of people talking about the bear coming back. So.
But there must be a lot more protections put in place in your industry, though.
There are, the capital requirements that you have to have, the type of products, the regulatory environment. Having said that, before, everybody was getting intoxicated, particularly south of the border, on what could be done, and a lot of people had some culpability in it along the way, but a dose of reality set in.
I think the movie The Big Short did a really good job showing that the whole thing was perpetuated by people operating in silos, where there was no malicious intent. It was just a lot of people who knew they were making money taking certain actions.
Doing that and also believing what they wanted to believe. Certainly you could accuse some of the rating agencies of that.
Right.
That
Definitely.
were giving AAA ratings to things that were nowhere close to that, and investors relying on those ratings to go ahead and keep going.
Right.
And even at the ground level, Barry Ritholtz posted an article this morning on that was in the Denver Post. Great story about this attorney that's spent the last decade interviewing people who made fraudulent mortgage applications. Unbelievable story when you think back to that time. People with no income getting 2, 3, 4 mortgages, and they figured they'd never have to make a payment, that it would go up so fast, and based on leverage, you'd flip out in 3 or 4 months and make all this money. And people lying about all kinds of different pieces of information. And that was the root of what caused these fraudulent mortgages to go through the system and then be wrapped up into other products with high ratings from the agency.
Exactly that. The thing I find fascinating, and going back to people believing what they want to believe, even down to that person or family buying a house and believing that it's going to go up 20, 30% inside of 12 months and keep borrowing and keep going on. My own personal psyche couldn't deal with that.
Yeah. So interesting.
No kidding. On to the next story.
Sure, yeah.
So last week, I don't know if you listened to it, Doug, or not, but we got Ben pretty fired up talking about the province of Ontario's decision to support the continuation of the deferred sales charge. So we had a lot of feedback from people that they liked hearing Ben riled up a little bit. And it got me to remembering an argument we used to make about how costs matter. And this is an article that I saw reposted on a blog site this week talking about the Investors Dividend Funds. Investors Group, of course, owned by Power Corp. They manage $130 billion, I believe. And their granddaddy fund is the Investors Dividend Fund. And it's around a $14 billion fund with an expense ratio in the 2.4% range, I believe. It's been around a long time. But I remember we used to make this argument about fees. So you take $14 billion, even at just over 2%, that's going to be a lot of money. So half of that revenue roughly goes to advisors for advisors' compensation, but still the amount of money left in the kitty for the company to manage the money comes up to just under $200 million or so, which basically has to be at that size close to an index fund, right?
Well, that's the whole issue of closet index funds, sure.
But can you imagine that amount of money being charged to run that kind of fund when you can get index funds at a fraction of that price? So, of course, Ben, being who he is, went back and nerded out and ran a regression on the fund. So what did you find out?
So we found kind of what you'd expect with a value fund is that it had statistically significant positive loadings to the value and quality factors. And it also had a negative alpha, which you'd expect from a high fee. And
so
also
what does that mean?
Alpha is value added in excess of risk taken.
So they took away value.
They subtracted value.
just to be clear.
Which is what you'd expect with high fees if you're not actually outperforming the market. So we looked, this data is from back to 2004. And the reason I went back to then is because that's when the DFA Canadian Core Equity Fund was launched. The A class and B class of the IG Dividend Fund were launched in 2003. They did have a class of the fund going back to 1962, but anyway, comparing to 2004, let's just compare it to DFA Canadian Core. So Canadian Core had an alpha of 0, which is interesting because it does also have a fee. That means Dimensional is adding enough value to cover their fee behind the scenes on this fund. They don't always have 0 alphas. Sometimes they're -2 because of fees, but anyway, this one's 0. Similarly value loaded, so almost the same coefficient in terms of value loading. The DFA fund did not have a quality loading, which the IG Dividend Fund did. The reason being, I think, DFA didn't start using the profitability screen, which is similar to quality, until 2014. So I didn't run a regression from 2014 on, but if I had, I would have expected to see some loading to quality. Anyway, so similar value loading, similar loading all around, actually. Dividend Fund had a lower market beta. The DFA Canadian Core, since July 2004, its inception, has returned 7.34%. Versus 4.98% for the IG fund. So, I mean, obviously the factor loadings explain it and the alpha explains it, but kind of what you'd expect. So I guess to summarize all that is that the returns of the IG fund are, they're underperforming the market, and they're also explained by factor exposure, which is obviously what you'd expect.
And I think this gets back to, Doug, your comment earlier about having confidence in this philosophy. So this isn't necessarily a dimensional story. It's about getting exposure to the factors that you want and then paying a competitive price to get those factors. That's the name of the game, right? In this case, you're getting factors you may not want that kind of mix, but you're paying a hefty price for those factors.
Yeah, I think, quite frankly, a lot of people just don't understand what's happening. At the individual level, and if they fully understood it, they'd be stepping back and asking questions.
Do you see your colleagues, coming back to that conversation, do you see your colleagues talking about things like income investing and seeking dividends and all that kind of stuff?
A couple, yes, and other ones, not so much.
Okay. Interesting. A couple more data points on the Investors Group fund. To be fair to the fund, it did only drop, it dropped 26% in the financial crisis, while the DFA Canadian Core dropped almost 39%. So there was some insulation from, I guess, what you'd call downside risk there. But if we look out 10 years, the worst 10-year return for Canadian Core was positive 2.89%, while it was 2.65% for the IG dividend. So even with the Investors Group fund, you got some insulation from the downturn, but over the long term.
And to their credit, they've done away with the DSC at Investors Group.
Yeah.
So
to their credit, I mean, they did it right before CRM2 disclosure started.
Right. But still.
Sure.
And if people see value in the service, that's fine. Everyone can pay what they want. If you prefer to pay higher fees, our only point is just be aware of the fee that you're paying and make sure you understand the factor.
And what you're paying for.
Yeah. But if you like paying that much, that's fine.
Yeah.
Right? Also interesting to note that they own, so Investors Group is owned by Power Corp, which owns Wealthsimple, which is a leader in the Robo space. I don't know if you hear much talk about Robo advisors in Toronto these days.
Definitely, yep.
Oh, yeah? What kind of stuff do you hear?
Just it's becoming more and more prevalent amongst the youth. My 24-year-old kids talk about that sort of stuff all the time, although they prefer to do their own online investing.
Right.
But it's out here in the market, that's for sure.
Are your kids couch potato investors too?
I would describe them as that, yeah.
Okay.
Very cool.
Another one that we know, getting back to Doug, you talking about cutting expenses. We know Ben's been talking about this Coho credit card that he uses to cut and manage his expenses. And then just poking around on the weekend, I discovered that Power Corp owns that too.
Yeah, I didn't know that when I started using it.
So it's kind of like all across the spectrum, Power Corp is there.
Coho's it's a preloaded credit card, so you define how much you're going to spend on discretionary items. When you started cutting expenses, did you guys use any specific tools to do that?
One of the ones we changed our credit cards to cashback cards.
Okay.
Started one with a fee and one without a fee. And now a couple of them do have fees, but we are far exceeding the money we're getting back just on normal, regular spending, nothing outside of, nothing towards the extravagant side. These things are more than paying for themselves. So that made a lot of sense.
Yeah, it's a smart move. So we did have a couple of listener questions that we should get to. Do you want to get to those now?
Sure.
So we had two good questions come in. On the last episode, I believe, I mentioned that the Dan Bortolotti's Canadian couch potato model portfolios are not perfect in some ways, even though they're pretty good. I think they're great. But the question came in, and I was kind of wondering if it would come in. What did I mean?
So what did you mean?
Well, so Dan has these 3 ETF portfolios, which are great in terms of simplicity. But even when you look at Justin Bender's Canadian Portfolio Manager blog model portfolios, he cuts them up further into more ETFs, which gives you a couple of things. It gives you flexibility to hold U.S. listed ETFs in your RSP account where it makes sense to reduce withholding tax or eliminate withholding tax in some cases. And it also gives you slightly lower MERs. So with Dan's super simple portfolios, you're getting simplicity, obviously, which is fantastic and probably the most important thing for most people. But you're giving up, or you're paying slightly higher fees, and you're giving up some flexibility in terms of tax location. And then, so that's kind of Dan's model portfolios versus what you could do with ETFs. And then the next step, I think, is we use the DFA products extensively, which obviously have the small cap and the value and the efficient trading and all of the benefits on implementation of those portfolios. So the couch potato portfolio doesn't have that at all. That's actually maybe a good question for you too, Doug. When you transitioned from couch potato to DFA, what were your thoughts around that, or how did you feel about that transition?
I felt confidence, certainly, and it was just sort of a justification of the project that we undertook to go after the proper retirement horizon. So it made a lot of sense to us.
Right, really interesting. So anyway, that's what I was talking about. That you give up some flexibility for simplicity, and then you also give up it's the same thing. You give up the tilts. So some cost efficiency, some tax efficiency, some factor exposure you're missing out on. Now, Dan's clearly aware of this. His model portfolios used to have small cap and value funds across the board in all of his geographic allocations. And I believe in 2015, when he updated his model portfolios, he completely stripped all of that out. I think he used to have his Uber-Tuber, which was 12 or 13 ETFs. And he wrote a post when he updated his model portfolios basically saying that based on his experience with the blog, he doesn't think that individual investors can handle a portfolio with that much complexity. So he's saying you're better off with something super simple.
Right.
Which an extreme case of is the Vanguard, the new Vanguard all-in-one portfolios. So again, you're paying slightly higher fees. You can't do tax location, but you place one trade and you don't have to rebalance.
Right.
Yeah.
And then the other question you got is, you talk about regressions a lot. How do you run them?
Yeah. So we do talk about regressions a lot because it's all about the factors, as everyone knows. We just use Excel. It's not very exciting. Ken French has a data library of global factors, and then AQR also has a data library that includes Canada-specific factors. So we use those for data sources, and then we do have access to Morningstar Direct to get fund return data to actually pull the fund returns, and then we just run the regression in Excel using the data analysis tool pack. Nothing fancy.
So something else for Doug on the fund side of things. So last time you and I had breakfast in Toronto at our favorite place, you mentioned that we should get to Toronto to see the play. Is it Come From Away?
Come From Away. Fabulous play. Seen it twice. Would be happy to see it 2 more times.
Wow.
So what's it about?
Canadiana. It's about September 11th and all the aircraft that had to land in Gander, Newfoundland, and how that town rallied to support basically almost doubling the population of the town with 37 planes that landed that day. It's a fascinating story. I don't know if you saw last week, but the U.S. Ambassador to Canada, Kelly Clark, on the anniversary of September 11th, was in Gander and described Gander as what the relationship between Canada and the U.S. really is.
Huh.
Wow. Amazing. Hard to get tickets?
You have to get them in advance, but they're still there. They've extended it again, actually.
Wow.
Terrific. Well, we're going to try to make it down in November, December if we can.
Maybe
You
go ahead.
No, I say, you still play guitar very much?
I do.
Did you get a band going?
The house band with the 2 kids. So our next gig will be the Christmas party.
Oh, of course. Yeah. What were you going to say?
I've got one more question for Doug before we wrap up. So you've made some very deliberate decisions in terms of saving, spending, retirement goals, how you're investing. If you could give advice to other people out there who maybe have not pulled the trigger on making those decisions yet, what would it be?
Don't believe that you know it all because you don't, and don't be afraid to reach out for professional help, and don't let fees deter you from doing that. Knowledge has value and is worth paying for.
Wow. That was unscripted.
Completely. It's awesome. Anything else you want to add, Doug?
No, just thanks for having me. I really enjoyed it.
This is great. We really appreciate it.
Thanks for helping.
All right.
See
That's
you
it.
next week.